We all knew this election was going to be close, but wow, has it been a journey. Who would have expected a visit to Traverse City from both the president and the vice president? Thank you to everyone who got out and voted. It's been great to see the record turnout that occurred and hope that that continues into the future. We are excited to be able to present a video that discusses some practical next steps for you to consider as a result of the election. And we purposely waited to present the topics because they varied so much given who wins from the election. But here we sit today and we still don't have a clear understanding of who it is going to be. We may have some feelings about it, but it didn't make sense to present today and put out there more what ifs or practical advice without knowing the true outcome of the election. So today we're pivoted and decided to put in the Part 3 Ask the Expert series with Courtney Danbrook from Danbrook, Adams & Raymond, where we're going to continue the discussion about estate planning. But know that that's even more important today in this year than any other year, given what may be coming down the road. Be sure to join us for next week's video where Rick Delaney and I, hopefully, will be able to present practical next steps for you to consider in tax planning based on whatever candidate does win. Given the extreme differences in fiscal policy, there is certainly going to be some critical items and next steps for you to implement. Thanks and enjoy the video. So what is something that you could advise that individuals think about right now? So as it relates to whether it's COVID, whether it's the upcoming presidential elections, whether it's the new tax law proposals that are there, that aren't there, the low tax rates, the high tax rates, just what is the current events, if you will, of estates tax planning and otherwise that you're seeing?
I would say the key word is uncertainty. There isn't a lot of certainty right now. And so even from a planning perspective, we're looking at a lot of different scenarios with respect to what's going to happen to the estate tax exemption level in 2025 when it sunsets. But I think the best thing that people can do right now in this period of uncertainty is revisit those plans, take those plans back out. People come into me with their heads down, holding their, estate plan binders, and I'm embarrassed to show you what the date is on this and that we haven't done anything to it. It's a great time to pull those out, take a look at them. Don't worry about, personally going through it. Again, that's part of my job is to walk you through what does it say and tell you, okay, here's what's different now with respect to tax laws. And then I ask, okay, now let's talk about you. What has changed since 1989 when you did your, I bet a lot has changed in life over that many years. And so just walking them through that process of, I know what your documents say, I'll tell you what they say. We'll talk about it from a tax law perspective, we'll talk about it from a planning perspective, but then helping them pull that information out that's really also important to the planning as far as what has changed in life that mandates a change within the documents themselves. So,
and are we primarily talking about a revocable trust then? Because if they've set up an irrevocable, it's very difficult. If are you even able to change an irrevocable trust? You
can, and it is able. When we talk about some of the more complex trusts, Cuperts, and those. ILETs, there are ways to terminate those, but you've got to look at what all the circumstances are and does it make sense? Are the benefits going to outweigh really the drawbacks of doing so? Because the idea of a lot of those trusts is they're irrevocable and they're that way for a reason. And so once we try to unwind those, what are the consequences going to be when we do that? And is it worth it? In some cases, it may be worth it. There were a lot of ILETs that people were looking at terminating.
So for everyone watching, what is an ILET? We throw out that acronym pretty easily. What is an ILET?
Yep, it's an irrevocable life insurance trust. Usually there is, it would hold a life insurance policy of a significant dollar amount. And by putting that in that trust, you are releasing essentially control over that asset so that can be outside of your estate and not be used to calculate part of your total estate upon your passing.
And then once the state exemption levels went through the roof, what is it, 11.8 million now?
Per individual.
Right, so the creators of those islets started to realize, I don't quite need this any longer.
Yep.
And so that prompted a flood of, okay, can we change this or terminate?
What can we do with it? Yep. What are the options?
And that actually is going to be a whole separate video that we're going to continue to have here as we look at what some of the consequences of having the higher estate tax limitation that's there. Is it going to go away? There's a lot of talk about in 2026 when it sunsets, is it going to flip back to what it was before or even further? So there is a lot of planning and consideration that gets involved with that specifically, and taking advantage of some of the first level tier of the standard deduction there, and then the second level deduction that's there. So I had someone ask me or talk about the idea, the concern that they were wondering about, and it was related to the concept that said one of the difficulties that we have with setting up a trust is that we're going to be forced to choose. Choose between my kids, or to make a judgment on, what's the right thing or what's the wrong thing. How do you help people navigate past that, or is just that something they're going to have to deal with?
No, absolutely. Again, part of my job is to walk people through some of those decisions. People always, they'll come in and they feel like their circumstance is somehow different than everybody else's. And I reassure them that although you think you're special and your situation is, there are so many people that are feel the same way or have family situations that are very similar to that. It's not uncommon for individuals to come in with children and say, gosh, I don't want to, if I choose one over the other, it's going to look like I'm favoring that child. And what then we do is really talk about what is the role that we're asking that child to serve in, or anybody to serve in, first of all, and every child is unique. And so what is the skill set that's going to be needed for that? And you'll see that, prime example is appointing somebody on your healthcare power of attorney versus a financial power of attorney. Those two decision-making abilities are a lot different. And the one child may be really good in those circumstances where they need to make a medical call somehow versus somebody who's very good at the financial and the business aspect of it. And so you can look at it from that perspective. Another thing is to look at, communicating to your kids or communicating to those individuals that you're appointing. Have that conversation with them during lifetime so that they know that they don't see the document and just assume, well, mom put Billy before Bob because she liked him better, which will always come up, but no. So having that communication. And then the other option is really think about, do we want to appoint a family member, or do we want to appoint a third party of some sort? Because then we eliminate the possibility of any of that tension altogether.
I know one thing that I've seen through estates and trusts that have come across what we're working on is, I tell people I like to think that the world revolves around solely dollars and money. That's all there is in life. But actually, quite frankly, it's pretty easy to split $100 between two people, 50 one way, 50 the other way. I see that division of assets actually going pretty well. Where I see more often than not our family fights and feuds that come afterwards are the non-financial side of things. And I'll tell people to think through what are those non-financial. Again, you can split a checking account. I can't split grandma's Bible that she treasured and had, or the family picture, or whatever the heirloom is. So what do you deal with that as well? Is that a separate document? Is it part of it, or what does that look like?
Yeah, absolutely. The what we call the tangible personal property, those things that, whether it's furniture, whether it's jewelry, artwork, all those things, that is usually the source of most tension, and that's because they hold some sentimental, there's a sentimental attachment to that these are things that we can hold on to even though our loved one is gone, that we have something. And so you'll see a lot of that tension, those feuds, always around personal property. And as part of the planning process, I always have that conversation with my clients to say, I know your children get along, but I can tell you that, regardless, there's always going to be sometimes an issue that could arise, and so let's try to avoid that. And one of the ways that we can do that is under Michigan law, we can do a written list for personal property. And that doesn't have to be in any specific format. You describe the item, who it's to go to, sign and date it, keep it with your estate planning documents, keep it updated, and then incorporate it in your plan is usually directing that trustee to say, look first for any written list I've prepared, distribute according to the written list. And so that's a big one. That's, just make it known what your wishes are.
And that's something that you can involve then the next generation on as well. So you may use that as an opportunity to talk around, Thanksgiving dinner or Christmas morning to say, okay, if you were to pick 3 or 5 things of ours, what would you really want? And you may find that actually they want different things, or they find that they all want the same one, but at least then you can deal with it while you're living still, and not afterwards.
Yep, I see a lot of the conversation happening around holidays and the use of masking tape under things. People will go to that extent to put names under things. The other part of that is, like you said, having that conversation, because you may think that person wants it, they may not want it. Right. And so have that conversation to say, gosh, what things are you interested in? And I also tell clients the best thing you can do is also give away those things during your lifetime. Watch that person enjoy it, rather than if it's a piece of jewelry sitting away in a jewelry box that you don't use, why not give that to the granddaughter, to your daughter, and have them be able to enjoy it and have you be able to watch them enjoy it too.
Jeff, what are the tax consequences of that? I can't get around with giving a gift without talking taxes. I mean, why just the pure innocence of giving a gift? I can't leave that one alone. So what are the tax consequences of that?
Well, if you're talking in the realm of gift taxes versus a specific bequest, those are 2 different things. Specific bequest in a trust document is tax-free as an inheritance. I receive it. And that's because the value of that item is already in that person's estate. So if their estate is high enough or large enough, they would be taxed on that through the estate tax. If it is just outright given, here's a piece of artwork, it's worth $10,000, and I want to give it to my son or daughter or whoever, then that's a reportable gift. And then you have to file a gift tax return and maybe pay a tax. But there again, the estate and gift tax exemption is so high, I've yet to see a gift tax triggered with clients.
Right, and right now, currently, the gift tax, before you even have to do a separate tax return, how much is that?
It's called the annual exclusion, so $15,000 gift. Now, this would be an accumulation for the entire year. So technically, Christmas gifts, here's $100, in a car, all those items added together, if it's more than $15,000 to one individual, then you must file a gift tax return.
So that's a common discussion that we'll have with who we're working with is, I need to think about this, but then B is okay, if we do, what are some strategies that we can use to give those items this year while you're living still and pass it through? And it may be for 10 years before, you're going to be talking about it and start shifting those dollars now versus later and avoid having to have tax implications at all. So that is something to think about as we can walk through both. So there is the monetary cash accounts and the assets and the property and everything, but there is the non monetary items too that we're dealing with. So.
Yeah.
Hey, Courtney, when someone who passes away and they have a trust and the trust owns some real estate, vehicles, that sort of thing, who's performing the valuations of that property? Is it even valued at death? Typically,
typically, again, given the significant increase in the estate tax exemption level, a lot of times if there is not a reason from, an estate tax standpoint or from, a distribution standpoint that we need to get formal appraisals, that we need to get values on all of that, we won't go through the formal process of doing that, but we still will determine values on the inventory that would be prepared upon somebody's death, even for a trust or a will, we'd be doing that. The more formal process of obtaining appraisals for real estate, that would be, is it dictated in the terms of the trust, and or is there a situation where say we have a provision that if one of the children wants to keep that piece of property for their portion of the share, we need to get it appraised so that we know what the fair market value is, so that the other children who are potentially going to be treated equally, we would know how much of the value to shift their way to.
Where we see that quite a bit would be, say, a family farm, where you've got the farm and you've got 2 kids that are going to continue on in the farm, and then you've got the other ones that are not going to continue on, or a business or something along those lines, or the family cottage or whatever. So you've got some that are taking one item, and then others are taking the different items.
Yeah. Yeah, and usually if we're approaching that estate tax level, or we think that we're going to have to file an estate tax return, absolutely you're going to go through the process of valuing those assets, getting the appraisals done, formal valuations, I should say.
Right.
Well, so before we wrap it up, I do want to ask one question here of Jeff or myself as we think through. Is we've asked Courtney to go through a lot of the details, but from a taxation point of view, now where we're dealing with a trust and will, I think the most common question I have is, am I going to pay taxes on it? You know, and I say that's a very general, broad thing, and I could probably talk. We could talk for the next several hours, but for everyone's sake here that's watching the video, we're not going to talk several hours, I promise. But what are a few key tax items that we have to be thinking about when it relates to tax of the trusts and estates and the beneficiaries?
There's a couple main questions that I receive. Is number one, I'm receiving this money out of a trust. Am I going to be taxed on all of this? And the answer is no. Quite a bit of what you receive from a trust is not part of the taxable income of the trust. So a portion of it will be taxable, but not all of it.
The way I like to kind of explain it on the question of whether I'm going to pay taxes on an inheritance is the tax is paid at the estate or trust level. And you've heard us talk on these videos of the significant increase there, that it's now $11.5 million. Think of it this way, that $11.5 million, or I say 11.5, it's actually a different number, it's about 11.8, but we're rounding for practical purposes of 11.5 million. Think of that as like a gigantic standard deduction that you see at the individual level. Everyone feels very comfortable with a standard deduction. So you can have a certain amount of income, you have a standard deduction that's taken it off, and you don't pay any taxes. So the estate is actually paying taxes, but it's at the 0% rate. I don't like paying taxes, but I love paying taxes at the 0% rate. So what's happening is the estate in the trust, as a separate standalone entity, is paying the taxes within that $11.5 million. So it's taking income, let's say, of $300,000, but it has a standard deduction of $300,000, and so it brings it down to the 0% rate. So when it comes to you as the beneficiary, it is tax-free because it's already been taxed. So you have what's called a step-up in basis. And so that's probably one of the most common scenarios that I deal with when we're talking about from the taxation standpoint. It also leads to the discussion topic that we'll probably have on another video, is there is discussion of whether or not that step up in basis is going to go away. And it is causing a lot of individuals to be doing some specific tax planning as it relates to whether or not there's going to be that step up in basis that's going to come through. So stay tuned for that. Thank you, Courtney, for coming and spending so much time with us going through some of these details. Again, the key takeaways here is that it's important to have either a will or a trust or something in place. It does not need to be complicated. There are a lot of opportunities to utilize more complicated items if it makes sense in your particular case, but don't let that be as a reason to stop. Reach out to Courtney, reach out to whoever, talk to your trusted advisors, and get that next step and move it forward. Thank you for joining us.
Thank you.